So it's been a really explosive start to the new year. Could even say we've changed gears very quickly. We've come in with global equities are up 6-7% already in the first 3 weeks. Bond yields have finally started to break up. 10-year treasuries in the US are up 25 basis points and broken clearly above the 2.5% level we've been watching for a little while. And everyone's sort of scratching their head and saying, is this too good to be true? How far is it going to go? So I think we've got to sort of step back and say what's really going on here. Now, the really big change, and this is something we've been talking about for the last 6 months, is this global synchronized pickup in growth that we've been focused on has become very clear to everyone. And we even saw the IMF come out yesterday, third week of January, and talk about global growth being 4%, which is the fastest growth we've seen since the early 2000s. So we've got this synchronized pickup in global growth, and the equity markets are going, what are the central banks going to do? The interest rate markets are saying not much, so the equities are going, this is fantastic. We can just expand what we expect from earnings and we're taking off. So this is an environment where you can actually see equities go what we call parabolic. They actually accelerate the trends that they've been in for some time. And we've seen this at the end of all good equity market runs. Before you get a crash, you often get this parabolic move up back in 99, even in 06, 07, but the 99, 2000 example stands out a lot. And again, we've got all these technology companies that are driving this like we saw back then. So are we going to have even more explosive move this year than we saw last year at equities? It depends, of course. So we've got a couple of scenarios in mind that can play out. First scenario is the Fed's well aware of this. They've watched while the financial conditions are getting easier. That's what they talk about. So the fact that equities are rallying, housing's doing well, the economy's doing well, they see this as more supportive of growth. We've got tax cuts coming through in the US, again more supportive. We'll probably have tax cuts here in Australia this year. So they're going to accelerate their pace of rate hikes. They're going to try and rein this in a little bit. So that's why we're thinking 4 rate hikes this year, and we're seeing short interest rates, say out to 2 years, in most countries in the world are starting to price in central banks getting more aggressive. The central banks focusing on financial stability. So the central banks might lean hard enough by raising rates to start to rein in this equity move, and the equities then start to get a little bit worried and they start to chop a little bit. Not a big problem, but it will take the steam out of this run. So that's our sort of more central scenario, and if you would ask me to put a number on it at the moment, that's where we're going 70%, 60-70%. Those central banks are engaged in that sort of fashion, and we've got central banks hiking more than we expect across the globe. A riskier scenario for these central banks right now, though, is they've been cooking this economy for so long, running such easy policy, that we could see wages and inflation start to lift. Now, we've done a fair bit of work around the wages and inflation story in the US in particular, but also in Australia, and we're expecting a continuation of the trend rise in wages and a modest pickup in inflation, but not alarming. But we can't dismiss the possibility now that we've got 30-year lows in unemployment in the US, Japan, UK and Germany, that we could see some wage pressures breaking out. And if that was to happen, then the central banks have left it too late to be putting interest rates up. Now, we're putting a 25% scenario on that, but it's a 25% scenario of an aggressive move by central banks to rein in the economies, which creates a recession in the next 1 to 2 years. So that's a genuine risk, and obviously a recession, we see equities down quite significantly. So that's our sort of 25% concern. We've got a possibility that this goes parabolic, but we also think the central banks are going to lean fairly hard into it. So when we get to the end of our probability tree and we start to say what are the markets going to do this year, we end up with probably a 70-80% conviction that short rates are going to see higher yields because the central banks are hiking more. A 60% likelihood that the bond markets are going to be higher because they're just going to get concerned about a little bit about inflation, but they're also getting concerned about the central banks stopping their bond purchases and starting to unwind. And then we had the 25% chance of the wages blowout. So we end up with a 50% chance that equities do a 10 to 15% correction, but we've also got 20-30% chance they could be up 20 to 30% this year. So that's a lot more volatility either way than what we've seen for the last few years. It's going to be a pretty interesting play.